Today we're going to talk a little bit about some of the investment options you have within your defined benefit plan. In reality, defined benefit plans can invest in almost any type of asset class, okay? But there are a lot of restrictions and a lot of things that you want to be concerned with. The most important rule that we would say is that you want to really limit your volatility in these plans. You really don't want, your assets going up 20% one year, down 20% the next year. Defined benefit plans are going to have stated interest rates, crediting rates in them. Typically, it's going to be 5% or some rather low rate. So in theory, you want to mimic that interest rate, okay? You're never going to get exactly 5%. In fact, if you get 2% or 10%, usually you're fine. What you really don't want is the up 20%, down 20%. That's really going to throw a lot of volatility in your plan. And the reason is that with a defined benefit plan, you're really looking to get a certain amount of money that's been earned at a retirement date, which is, 5, 10, 20 years down the road. So because you're trying to earn this, obtain this specific balance, you can get that balance with contributions to the plan or with investment earnings and gains on the assets in the plan. So if you have very large gains, very large asset returns, well, then of course you don't need to make large contributions to the plans because you've got large asset increases. Likewise, if you lose a lot of money in a plan, you'll have to catch that up because again, we've got this defined benefit at retirement. So therefore we're going to need to increase our contributions to the plans in order to get that defined benefit that we're looking for down the road. Okay. So one of the things we'll tell clients a lot is, look, if you've got a defined benefit plan and a 401k plan, take your aggressive investments like your Bitcoin, your Tesla stock, anything with a lot of volatility, and you want that to be inside of your 401k or even any old IRAs or SEPs that you've got. Make that stuff your most risky investments, your most volatile investments. Keep your defined benefit plan assets much more vanilla. You might want to do, a lot of people will do, say, 20% S&P 500 index, 20% REITs, 10% foreign stocks, 20% bonds, certain commodities and things like that. So there's a lot of different asset classes that you can blend. So that way you can be in the neighborhood of, hopefully 0 to 10%. Obviously, there's no guaranteed investment returns. But again, you just don't want wide fluctuations because you want to keep your contribution levels rather consistent. In fact, the number one reason people do these plans is for the tax deductions of the contributions. So if you have huge increases, it's going to minimize those tax deductible contributions and can make it a little bit more cumbersome when you're in a very high tax bracket if you want to get some large contributions in. So again, to summarize, you can invest in almost anything, but you do want to keep these assets a little bit more conservative. Put your aggressive stuff in 401ks, IRAs, other types of defined contribution plans. Keep your defined benefit plan investments a little bit more conservative, and that way you'll be able to preserve those consistent funding levels so you can get the maximum tax deduction available to you.